Every banking crisis creates winners and losers. And for more than a decade, JPMorgan Chase has consistently been one of the biggest winners. When fear spreads across the financial system, customers don't run away from JPMorgan. They run toward it. Deposits increase. Market share expands. And competitors often emerge weaker. The question is, why does every banking crisis seem to make JPMorgan even stronger? And more importantly, is the stock still attractive today? Let's find out. JPMorgan may be one of the strongest banks in the world. But even a great business can deliver disappointing returns if investors overpay. That's why valuation is so important. Investing isn't just about finding great companies. It's about finding great companies at the right price. The real question is, has the market already priced in JPMorgan's strengths? Or is there still an opportunity for long-term investors today? Let's take a closer look at the valuation. Before deciding whether a stock is cheap or expensive, we first need to estimate its fair value. Fair value is an estimate of what a business is truly worth based on its future earnings, cash flows, and long-term growth potential. It's not an exact number. Instead, it's a range that helps investors determine whether the current market price offers an attractive opportunity. If a stock trades significantly below its fair value, it may offer a margin of safety. If it trades well above fair value, future returns could be limited, even if the business continues to perform well. For JPMorgan, we'll estimate fair value using earnings-based assumptions and compare those estimates with the current share price. This helps us understand what the market may be expecting, and whether those expectations are reasonable. Let's break down what these numbers actually mean. We use 3 valuation scenarios to estimate what JPMorgan could be worth. The first is the conservative case, which values the company at about $255 per share. The second is the historical case, based on JPMorgan's average valuation over time, producing a fair value estimate of roughly $283 per share. And the third is the optimistic case, where stronger market sentiment pushes the valuation to nearly $345 per share. Rather than focusing on a single number, investors should think in terms of a valuation range. In this case, JPMorgan appears to be worth somewhere between $255 and $345 per share, with $283 serving as our base case estimate. The next question is simple. Where is the stock trading today? And does that price provide enough margin of safety for long-term investors? Before we can determine whether JPMorgan is a good investment, we first need to understand how the business actually makes money. JPMorgan Chase is not just a bank. It is one of the largest and most diversified financial institutions in the world. Serving consumers, businesses, corporations, governments, and investors across more than 100 countries. The company's business is built around 4 major segments, each contributing to its earnings in different ways. This diversification is one of the key reasons JPMorgan has remained resilient through multiple economic cycles and financial crises. Consumer and community banking. The first segment is consumer and community banking. This is the part of JPMorgan that most people interact with every day. It includes checking accounts, savings accounts, credit cards, mortgages, and auto loans. Millions of customers use JPMorgan's banking services, providing the company with a large and stable deposit base. These deposits serve as a low-cost source of funding and represent one of the bank's most valuable competitive advantages. Commercial banking. The second segment is commercial banking. Here, JPMorgan serves small businesses, middle-market companies, and large corporations. The bank provides loans, treasury services, cash management solutions, and financial advice. As businesses grow, many continue to rely on JPMorgan for financing and operational banking needs, creating long-term customer relationships. Corporate and Investment Bank. The third segment is the Corporate and Investment Bank. This is JPMorgan's Wall Street operation. The company advises clients on mergers and acquisitions, helps businesses raise capital, and facilitates trading activities across global financial markets. JPMorgan is consistently ranked among the leading investment banks in the world. This segment can be more cyclical than traditional banking, but it also provides significant earnings potential during strong market environments. Asset and Wealth Management. The fourth segment is Asset and Wealth Management. This business manages money on behalf of individuals, families, institutions, and governments. As client assets grow, JPMorgan earns management and advisory fees. Unlike lending businesses, this segment generates recurring fee income and requires relatively little capital, making it an attractive source of long-term profitability. Why the business model matters. What makes JPMorgan unique is not just the size of these businesses, but how they work together. When one segment faces challenges, another may help offset the weakness. During periods of lower loan growth, wealth management fees may remain strong. When capital markets activity slows, consumer banking can continue generating stable earnings. This diversification helps reduce volatility and creates a more resilient business model. And that's one of the reasons why, throughout multiple banking crises, JPMorgan has often emerged stronger than many of its competitors. Banking is one of the most competitive industries in the world. Thousands of institutions compete for the same customers, deposits, and lending opportunities. Yet year after year, JPMorgan continues to outperform many of its peers. So what makes JPMorgan different? The answer lies in a combination of scale, diversification, financial strength, and trust. These advantages have been built over decades and become even more valuable during periods of uncertainty. Scale creates advantages. JPMorgan is the largest bank in the United States by assets. Its massive scale allows the company to spread costs across millions of customers and thousands of businesses. Whether it's investing in technology, cybersecurity, artificial intelligence, or regulatory compliance, JPMorgan can spend billions of dollars while maintaining strong profitability. Smaller competitors often struggle to match these investments. As a result, scale creates a competitive advantage that becomes increasingly difficult to replicate. The power of deposits. One of the most valuable assets a bank can have is a strong deposit franchise. Deposits provide the raw material for lending and investing. And JPMorgan controls one of the largest deposit bases in the world. During times of economic stress, customers often move their money toward institutions they trust most. This creates a powerful cycle. More deposits provide lower-cost funding. Lower-cost funding supports higher profitability. And higher profitability allows JPMorgan to invest even more in its business. Diversification across the financial system. Unlike many banks that depend heavily on one source of revenue, JPMorgan generates earnings from multiple businesses. Consumer banking. Commercial banking. Investment banking. Trading. Wealth management. Asset management. This diversification helps reduce risk and creates multiple engines of growth. When one segment slows down, another can often help offset the weakness. As a result, earnings tend to be more resilient across different economic environments. Financial strength during crises. Perhaps the biggest difference is how JPMorgan performs during financial stress. Many banks focus on surviving a crisis. JPMorgan often uses crises as opportunities to strengthen its competitive position. During periods of market uncertainty, customers seek safety. Investors seek stability. Businesses seek reliable financial partners. And more often than not, JPMorgan becomes one of the primary beneficiaries of that shift in confidence. The trust advantage. Banking is ultimately a business built on trust. Customers trust a bank with their savings. Businesses trust a bank with their operations. Investors trust a bank with their capital. Over many decades, JPMorgan has built a reputation as one of the strongest and most reliable financial institutions in the world. That reputation cannot be easily copied. And during times of uncertainty, trust becomes one of the most valuable assets a bank can possess. Key takeaway. JPMorgan's advantage is not based on a single product or service. It's the combination of scale, deposits, diversification, financial strength, and trust. Individually, each advantage is meaningful. Together, they create a powerful competitive moat that has helped JPMorgan navigate economic cycles, outperform many competitors, and emerge stronger from nearly every banking crisis. When investors talk about JPMorgan's success, one name inevitably comes up: Jamie Dimon. While JPMorgan's scale, brand, and financial strength are important, many believe one of the company's greatest assets has been its leadership. For nearly 2 decades, Jamie Dimon has helped guide JPMorgan through some of the most challenging periods in modern financial history. And under his leadership, the bank has not only survived, it has often emerged stronger. A proven crisis manager. Since becoming CEO in 2005, Jamie Dimon has faced events that could have severely damaged many financial institutions. The global financial crisis. The European debt crisis. The COVID-19 pandemic. And the regional banking crisis of 2023. Yet throughout these periods, JPMorgan consistently demonstrated resilience. Strong capital levels. Conservative risk management. And disciplined decision-making helped the company navigate uncertainty while many competitors struggled. Thinking long-term. One characteristic that sets Jamie Dimon apart is his long-term perspective. While many public companies focus heavily on quarterly results, JPMorgan often invests for the next decade. Billions of dollars have been spent on technology, cybersecurity, digital banking, and artificial intelligence. These investments may reduce short-term profitability, but they strengthen the company's competitive position over the long run. This approach reflects a philosophy that prioritizes durability over short-term optimization. Discipline during good times. Leadership is often tested during crises, but it can be even more important during periods of prosperity. Many financial institutions take excessive risks when conditions appear favorable. JPMorgan has generally maintained a more balanced approach. The company focuses on capital strength, liquidity, and risk controls even when markets are booming. This discipline helps explain why JPMorgan often enters downturns from a position of strength. Building a culture of excellence. Great companies are rarely built by one person alone. But great leaders often create cultures that outlast them. Over the years, Jamie Dimon has helped build a culture focused on performance, accountability, risk management, and client service. That culture influences decisions across the organization, from consumer banking to investment banking and wealth management. And it has become an important part of JPMorgan's competitive advantage. The succession question. Of course, no CEO stays forever. One of the questions investors continue to ask is, What happens after Jamie Dimon? Leadership transitions always introduce uncertainty. Especially when a company has been associated with a highly successful CEO for such a long period. However, JPMorgan has spent years developing a deep management bench and preparing future leaders. While replacing Jamie Dimon may be difficult, the company's strength ultimately extends beyond any single individual. Key takeaway: Jamie Dimon is not the reason JPMorgan is successful. But he has undoubtedly been one of the key architects behind that success. His focus on risk management, long-term thinking, operational excellence, and financial discipline has helped shape JPMorgan into the institution it is today. And while leadership alone does not make a stock a good investment, it is one of the reasons many investors view JPMorgan as the gold standard in banking. To understand whether JPMorgan remains a high-quality business, we need to look beyond the headlines and examine the company's actual financial performance. And in the first quarter of 2026, JPMorgan once again delivered strong results across multiple business segments. Strong revenue growth. JPMorgan reported managed revenue of approximately $50.5 billion, representing a 10% year-over-year increase. Growth was driven by higher net interest income, stronger investment banking activity, asset management growth, and record trading revenue. What's notable is that growth was broad-based. Consumer banking, commercial and investment banking, and asset and wealth management all contributed positively to overall performance. Earnings remain exceptional. Net income reached approximately $16.5 billion, while diluted earnings per share came in at around $5.94. Both figures exceeded market expectations and reflected the company's ability to generate substantial profits even in a more uncertain economic environment. For perspective, very few companies in the world are capable of generating more than $16 billion in profit in a single quarter. This highlights the scale and earnings power of JPMorgan's business model. Investment banking and trading lead growth. One of the biggest drivers this quarter was the commercial and investment bank. Segment revenue increased approximately 19% year-over-year, while net income surged around 30%. Investment banking fees climbed roughly 28%, supported by stronger deal activity and capital market transactions. Meanwhile, markets revenue rose about 20%, reaching record levels as volatility created more trading opportunities. This demonstrates JPMorgan's ability to benefit from periods of market activity while maintaining leadership in global investment banking. Consumer banking remains resilient. Despite concerns about the economy, consumer activity remained relatively healthy. Consumer and community banking generated nearly $5 billion in net income, while revenue increased approximately 7% year-over-year. Credit card spending remained solid. Deposit balances stayed strong. And credit performance continued to show resilience. This suggests that consumer financial health, while closely monitored, has not yet shown signs of major deterioration. Wealth management continues expanding. Asset and wealth management also delivered another strong quarter. Revenue increased roughly 11%, while assets under management approached $4.8 trillion. This segment is particularly attractive because it generates recurring fee income and generally requires less capital than traditional lending businesses. As client assets grow over time, wealth management can become an increasingly important contributor to profitability. Profitability remains elite. One of the most impressive metrics was JPMorgan's profitability. The company reported a return on tangible common equity, or ROTCE, of approximately 23%. For a bank of this size, that is an exceptionally strong result. High returns on capital often indicate a business with competitive advantages, strong execution, and disciplined management. And historically, JPMorgan has consistently generated returns above many of its banking peers. Balance sheet strength. JPMorgan also maintained a strong capital position. The bank ended the quarter with a CET1 ratio of approximately 14.3%, comfortably above regulatory requirements. Strong capital levels provide an important cushion during economic downturns and help support long-term stability. This financial strength is one reason why investors often view JPMorgan as one of the safest institutions in the banking sector. Key takeaway. Overall, Q1 2026 demonstrated why JPMorgan continues to be viewed as one of the highest quality banks in the world. Revenue grew. Earnings remained strong. Investment banking recovered. Wealth management expanded. And profitability stayed at elite levels. While risks still exist, the quarter showed that JPMorgan's diversified business model continues to generate significant earnings power across different parts of the financial system. JPMorgan is widely regarded as one of the strongest banks in the world. But no business is risk-free. Even the highest quality companies face challenges that can impact earnings, valuation, and shareholder returns. Understanding these risks is just as important as understanding the company's strengths. Because successful investing isn't only about identifying opportunities. It's also about recognizing what could go wrong. Credit risk. The first and most obvious risk is credit risk. Banking is fundamentally a lending business. JPMorgan lends money to consumers, businesses, corporations, and governments. If borrowers are unable to repay their loans, the bank can experience higher credit losses. During economic downturns, unemployment tends to rise, business activity slows, and default rates can increase. While JPMorgan has historically maintained strong underwriting standards, no bank is completely immune to credit cycles. A severe recession would likely pressure earnings through higher loan loss provisions and weaker loan growth. Economic slowdown. JPMorgan's performance is closely tied to the health of the broader economy. When businesses invest, consumers spend, and financial markets remain active, the bank benefits. But during periods of economic weakness, activity can slow across multiple segments simultaneously. Loan demand may decline. Investment banking activity can weaken. Trading volumes may become unpredictable. And wealth management clients may become more cautious. Although diversification helps reduce the impact, economic cycles remain an unavoidable risk for any large financial institution. Interest rate risk. Interest rates can have a significant influence on bank profitability. Rising rates may initially support net interest income. However, higher rates can also slow borrowing activity and increase pressure on consumers and businesses. On the other hand, falling rates may reduce lending margins and lower profitability. Predicting the path of interest rates is difficult. And changes in monetary policy can create both opportunities and challenges for JPMorgan's earnings outlook. Regulatory risk. Banking is one of the most heavily regulated industries in the world. Following every major financial crisis, regulators often introduce new rules, capital requirements, and compliance standards. As the largest bank in the United States, JPMorgan receives significant regulatory scrutiny. Future regulations could require the company to hold more capital, limit certain activities, or increase compliance costs. While these measures are designed to strengthen the financial system, they can also affect profitability and returns on equity. Market and investment banking risk. JPMorgan's investment banking and trading businesses are major strengths. But they can also introduce volatility. Revenue from mergers and acquisitions, capital markets activity, and trading often depends on market conditions. During periods of uncertainty, companies may delay transactions and investors may become less active. As a result, earnings from these segments can fluctuate more than traditional banking operations. Leadership transition risk. Another risk investors should consider is succession. Jamie Dimon has been one of the most respected leaders in the banking industry for nearly 2 decades. His leadership has played an important role in shaping JPMorgan's culture and strategy. Eventually, the company will transition to a new generation of leadership. While JPMorgan has a deep management team, leadership changes always create uncertainty and represent a risk worth monitoring. Key takeaway: none of these risks are unique to JPMorgan. In fact, many competitors face similar or even greater challenges. However, investors should remember that banking remains a cyclical business. Earnings can fluctuate. Economic conditions can change. And unexpected events can impact the financial system. The good news is that JPMorgan's scale, diversification, strong balance sheet, and disciplined risk management provide important defenses against many of these risks. But like any investment, understanding both the opportunities and the risks is essential before making a long-term decision. We've discussed JPMorgan's business model, competitive advantages, financial performance, and key risks. Now it's time to focus on what matters most for investors: the future. Because investing is not about what a company has achieved in the past. It's about what the business can deliver over the next 5, 10, or even 20 years. So, what does the future look like for JPMorgan? Multiple growth engines. One of JPMorgan's greatest strengths is that it doesn't rely on a single source of growth. The company benefits from multiple business segments that can support earnings over time. Consumer banking continues to grow through credit card spending, digital banking adoption, and customer acquisition. Commercial banking benefits from economic expansion and increased business activity. Asset and wealth management continues to attract client assets, generating recurring fee income. And investment banking stands to benefit whenever capital markets become more active. Together, these businesses provide multiple pathways for long-term growth. Technology as a competitive advantage. JPMorgan is also investing heavily in technology. Every year, the company spends billions of dollars on digital infrastructure, cybersecurity, data analytics, and artificial intelligence. These investments are designed to improve efficiency, enhance customer experience, and strengthen risk management. While the benefits may take years to fully materialize, they could help JPMorgan maintain its competitive advantage in an increasingly digital financial system. The power of scale. Size alone doesn't guarantee success. But when combined with strong execution, scale can become a powerful advantage. JPMorgan's enormous deposit base, customer network, and global reach allow it to compete in ways that smaller institutions simply cannot. In many cases, the company's scale helps lower costs, improve profitability, and strengthen customer relationships. And during periods of uncertainty, that scale often becomes even more valuable. Capital returns. Another important part of the investment story is capital returns. JPMorgan has a long history of returning capital to shareholders through dividends and share repurchases. As long as earnings remain strong and the balance sheet stays healthy, investors can potentially benefit from both business growth and shareholder distributions. Over long periods of time, these returns can play a significant role in overall investment performance. What could go right? In a favorable scenario, economic growth remains resilient, credit quality stays healthy, and financial markets remain active. Under those conditions, JPMorgan could continue growing earnings while maintaining strong returns on capital. Combined with dividends and share repurchases, that could support attractive long-term shareholder returns. What could go wrong? On the other hand, investors should remain realistic. A recession, rising credit losses, weaker loan demand, or prolonged market weakness could slow earnings growth. Regulatory changes could also impact profitability. While JPMorgan is better positioned than many competitors to navigate these challenges, it is not immune to them. Key takeaway. Ultimately, JPMorgan's investment thesis is relatively straightforward. This is not a company trying to reinvent itself. It is a mature, highly profitable institution with a dominant market position and multiple competitive advantages. The company may not deliver explosive growth. But if management continues to execute well and the business continues to compound earnings over time, JPMorgan could remain a compelling long-term investment. The question for investors is not whether JPMorgan is a great bank. The question is whether today's price offers an attractive opportunity to participate in that long-term growth story. JPMorgan is often considered the gold standard of banking. But to understand whether that reputation is deserved, we need to compare the company against some of its largest competitors. Because great businesses don't exist in isolation. They compete every day for customers, deposits, loans, talent, and market share. So how does JPMorgan stack up against the rest of the industry? Scale and market position. Among major U.S. banks, JPMorgan stands at the top. Its balance sheet is larger than most competitors, giving the company access to more deposits, more lending opportunities, and greater financial flexibility. This scale allows JPMorgan to invest heavily in technology, risk management, and customer acquisition. While competitors can certainly compete in specific areas, very few can match JPMorgan's breadth and reach across the financial system. Profitability. One of the clearest indicators of business quality is profitability. Over the past decade, JPMorgan has consistently generated strong returns on equity and tangible equity. Compared with many large banks, the company has demonstrated an ability to convert its scale into shareholder value more effectively. Strong profitability often reflects a combination of competitive advantages, disciplined risk management, and efficient operations. And in each of those areas, JPMorgan has generally performed well. Diversification. Some banks specialize in consumer banking. Others focus primarily on investment banking or wealth management. JPMorgan does all of them. The company generates earnings from multiple business lines, reducing dependence on any single source of revenue. This diversification helps stabilize earnings during economic cycles and provides multiple growth opportunities over time. Few competitors possess such a balanced business mix. Performance during crises. Perhaps the biggest difference becomes visible during periods of financial stress. Banking crises often reveal which institutions are truly resilient. Throughout multiple economic downturns and financial disruptions, JPMorgan has consistently demonstrated strong capital levels, disciplined risk management, and operational stability. While competitors focus on recovery, JPMorgan has often emerged with stronger market share and greater customer confidence. That's one reason many investors view the company as a defensive choice within the banking sector. Leadership and execution. Another area where JPMorgan has often distinguished itself is execution. Great strategies mean little without strong management. Under Jamie Dimon's leadership, the company has built a reputation for disciplined decision-making and long-term thinking. While competitors have also made significant improvements, JPMorgan's execution record remains one of its strongest advantages. The trade-off. That said, being the best doesn't always mean being the best investment. High-quality businesses often command higher valuations. Investors are frequently willing to pay a premium for companies with strong profitability, durable competitive advantages, and proven management teams. As a result, competitors with weaker businesses may occasionally appear more attractive from a valuation perspective. The challenge for investors is determining whether JPMorgan's superior quality justifies any valuation premium. Key takeaway. When compared to its major competitors, JPMorgan stands out for its scale, diversification, profitability, and resilience. It may not always be the cheapest bank stock, but it has consistently proven itself to be one of the highest quality institutions in the industry. And that's why many long-term investors view JPMorgan not simply as a bank, but as a compounding machine built to endure across economic cycles. So, what have we learned about JPMorgan Chase? First, this is not just another bank. JPMorgan has built one of the most powerful financial franchises in the world. Its scale, diversified business model, strong deposit base, and global reach create advantages that few competitors can replicate. Second, the company has demonstrated remarkable resilience across multiple economic cycles. Whether during the global financial crisis, the pandemic, or the regional banking turmoil of 2023, JPMorgan consistently emerged as one of the strongest institutions in the industry. Third, management has played a critical role. Under Jamie Dimon's leadership, the company has maintained a disciplined approach to risk, capital allocation, and long-term investment. And finally, the business continues to generate impressive profitability while returning significant capital to shareholders through dividends and share repurchases. The investment perspective. However, great businesses do not automatically become great investments. Future returns will depend on the relationship between business performance and the price investors pay today. While JPMorgan may not offer explosive growth, it doesn't need to. The company's strength lies in its ability to steadily compound earnings, generate strong returns on capital, and navigate uncertainty better than many of its peers. For long-term investors, that combination can be incredibly valuable. Final takeaway. When I look at JPMorgan, I don't see a company trying to become the next big thing. I see a company that has already established itself as one of the most important financial institutions in the world. A business built on trust. A business strengthened by scale. And a business that, time and time again, has proven its ability to come out stronger when others struggle. Which brings us back to the original question. Why does every banking crisis seem to make JPMorgan stronger? Because when uncertainty rises, trust becomes more valuable. And few institutions have earned that trust more consistently than JPMorgan Chase. Whether the stock is attractive today depends on your valuation assumptions and expected return requirements. But from a business quality perspective, JPMorgan remains one of the strongest banking franchises investors can own. And for many long-term investors, that's exactly where the story begins. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching, and if you enjoyed this analysis, don't forget to like, subscribe, and share your thoughts in the comments below.